Well, good morning, everyone. All right, how's everyone doing this morning after Thanksgiving? All right, I think we're ready for our presentation. It feels like I'm doing a Christmas pageant up here with all the poinsettias and the music, but hopefully we'll have a great day today talking a little bit more about tax deductions and tax credits. This is always one of my favorite areas to discuss here at the tax training, because now we're going to talk about taking money away from the government and putting it back in the hands of our clients. So this is always a fun part for me to talk about the various options we have to make sure that we are increasing refunds for our tax preparers. So just want to go over a couple of the rules for you. There'll be a couple things that are staying the exact same and a whole bunch of new changes for the first time this year, which we'll cover toward the end. In fact, that's one of the reasons why some of the printed material is not going to be available, because of the changes that need to be done to those materials. So we want to give you the best information we have available today, talk about a couple of tips and techniques moving forward here as well. So one of the things we want to talk about here is to get into the various levels of deduction and credit and other things available for our taxpayers. So one of the things we're going to take a look at first is our adjustment to income. Now, adjustment to income are deductions that are going to be available to taxpayers, whether they have itemized deductions or standard deductions. So we'll talk about these. These are generally what we call deductions for AGI. So these are going to be things within scope for VITA, would be things like the educator expenses, the health savings account deduction, taking a look at the penalty on early withdrawal from CDs or savings accounts, alimony, IRA deduction, and then also student loan interest. So I just want to start off with the deduction side of things. And these, as I mentioned, will be available irrespective of whether you itemize or take a standard deduction. And I'll talk about a couple more of those as we get back at the very end of this presentation. So taking a look at the educator expenses, fortunately the rules have not changed from the prior year. Educator expenses, hopefully in the new version, the 4012, will still be on E10, but educators can deduct up to $300 per qualifying educator. So on a return, we can take up to $600, but it's up to $300 each for each of the taxpayer and spouse. So what do we mean by a qualified educator? Anyone who's going to be a teacher, instructor, counselor, principal, or aide in the school. We're looking at K through 12. So unfortunately, homeschooling doesn't count, pre-K doesn't count, and secondary education doesn't count. So we're looking at just K through 12 education. As long as you're employed for at least 900 hours throughout the year, you can qualify. So this does expand that definition. So people may think it's only the teachers. It actually includes the aides and counselors as well. So there's a couple other caveats. So that does include any instructional material. So that could be including books, supplies, any equipment. That includes computer equipment and software. Also includes any material used in the classroom. So that can be bulletin boards, that can be any type of instructional material. It also covers things like personal protective equipment. So if teachers need to provide their own Clorox wipes, that would be includable as a deduction as well. If they have any professional development activities, if they have to go to conferences, if they take on additional training, that can also be included. Now, however, the tax rules say that if a reimbursement was offered by the school and not taken by the educator, they cannot then use that same expense here for the educator deduction. So if they have the opportunity to be reimbursed by their employer, they should be taking advantage of that first. Now, this is always one of the unique things. Whenever we talk about deductions and credits, generally we're going to see that there are very specific rules or very targeted elements that we have for these deductions and credits. Congress is going to go ahead and basically allow very specific regulations, very specific rules. One of them, and this is what's kind of fun about talking about it, is understanding where people did not like their education. And I'm assuming somewhere in Congress there was a congressperson or senator who did not enjoy physical education or health. Because there's one caveat. If you're a physical education or health instructor, you have some limitations. So other teachers, other aides, counselors, principals are fine, but we do have a issue where the only expenses allowed for health and physical education teachers would be athletic supplies. So we can't include expenses for non-athletic supplies for health instructors or physical education. And again, no homeschool expenses. So somewhere in Congress, they thought this was a great idea to benefit all teachers, and someone put their hand up and said, wait, not for physical education teachers. That is absolutely not going to work. Anyone else, fine, but not health and not physical education. So if you do get a client who's a health or phys ed teacher, just apologize and say, unfortunately, non-athletic supplies are not included in that list. Hopefully we don't see many of those, but it is one of those unique carve-outs we see here with the tax code. One of the bigger ones we'll probably see, though, is the health savings account. So that will be a relatively popular type of deduction now. Where the health savings account comes in is when an individual has a high deductible insurance plan. What we mean by this is effectively the high deductible insurance is going to provide, for the most part, a lower monthly insurance premium, but it takes a while before the insurance will kick in. So they have a much higher deductible before the insurance will go ahead and pay medical costs. Becomes quite popular for individuals who might be a little bit younger, who may not have quite significant medical needs, or they don't anticipate significant medical needs. The benefit of this type of plan is that an individual can then put money into a health savings account. That health savings account is actually going to grow tax-free, and the proceeds can be taken out tax-free as long as they're used for qualified medical costs. So it becomes a very, very popular option. We actually see some people from financial planning suggesting we use HSAs and other type of plans as an alternative. Because what you're going to get is a tax deduction. For the money that you put in today, it's going to be deductible from income taxes, and again, grows tax-free. And then, obviously, if it's used effectively, will be also tax-free on the back end. So what we're going to take a look at is to double check and see if an individual is participating in an HSA. Usually you'll find this on a W-2, code W on a box 12. Means that they have made HSA contributions through a pre-tax program. That basically they're electing to go ahead and have those contributions taken out of their pay. They're not going to be paying tax on those. That can also include any employer contributions as well. Now, one thing we have to just watch is that we don't double up. So if you ask someone if they have an HSA, they say, sure, how much did you put in? $600. We don't want to go ahead and take another $600 deduction on the return. If it's already taken out pre-tax, we cannot take it a second time. So fortunately, TaxSlayer does a pretty good job of seeing where that W code's coming from on the W-2, and it should populate the correct HSA forms. So generally, we'll see all the contributions and distributions on the form 8889. Now, the limitations we have, the contribution for 2025 will be $8,300 for a family plan and $4,150 for an individual. So that's the maximum amount that they can put in. Now, the good part about the HSA is even though most people probably contribute through their payroll withholding, they do have the ability up to the due date of the return to go ahead and fund even more. It's a popular technique. I use it quite a bit in my practice, particularly if we need to get an additional tax deduction or the individual knows that they have the ability to maximize some additional tax benefit. Not quite sure how much in practice we see it at VITA, that people come in and say, oh, I'll gladly put another $2,000 in my HSA, but we do have that ability to do so. So we just want to make sure that we have the appropriate contributions already accounted for. Again, for the most part, most of the individuals I see have that automatically withheld from their pay. So typically, again, code W out of box 12 of the W-2. Now, the other benefit is if they're age 55 or older, they also get another $1,000 they can put into their HSA. Now, HSA contributions work as long as you are in the plan. Once you're eligible for Medicare, you can no longer contribute to an HSA plan. So just something to take in mind as we have people maybe transitioning from the work field into retirement. They can no longer contribute once they're Medicare eligible. A couple other things that we also want to take a look at here in addition to the contributions is understanding the distribution rules. So the distributions are also going to be reported on the 8889. Generally, the taxpayer is going to receive a Form 1099-SA. That's going to show the amount of distributions from the account. Now, the good news is as long as those distributions are used for qualified medical costs, so that includes anything for the taxpayer, their spouse, and or their dependents. So they can use that pretty much in a very broad environment. Or they roll that over to another HSA. That may happen if people are changing plans. But when we take a look at these opportunities here, and I do apologize. The HSA contribution limits I gave you before, it's 8,550. So 8,550 for the family, 4,300 for the self only. An additional 1,000 again for the 55 and older. But the costs that we're allowed to deduct are anything, obviously prescriptions, so people usually use these at a pharmacy. The rule changed recently that now you can actually do over-the-counter medication without a prescription. So that includes cold and flu medication. That includes any type of home testing for COVID. It also includes personal protective equipment as well. So there's a number of areas that people can use their HSA funds for. But that includes any doctor bills, any co-pays, any dentist, any eye or optometry work, anything along those lines are all deductible or at least qualified as medical costs. So the best way to take a look at it, if it would be considered a medical deduction under itemized purposes, we can take that as a qualified medical expense under the HSA. Now, the good news is most times to get money out of the HSA, you have to be very deliberate. Most times you'll get an HSA debit card. That debit card is not going to work at your local gas station to try and fill your tank. It's generally only going to work for purposes of going to the pharmacy, going to your medical office, or using it for payment for other eligible costs. So the good news is most people don't take money out of their HSA. We don't encourage them to try and take money out of the HSA unless it is for qualified medical care. So for the most part, most of the situations I've seen, if we see that 1099 SA that shows maybe $1,500 in medical costs, the question is, did you spend at least $1,500 on qualified medical costs? The answer is typically absolutely, or I have no idea, but I think I did. Again, remind the taxpayers it's their responsibility to document. It's what will come through the HSA. Usually their HSA account, if they look that up, will show where those amounts had been spent. So a pretty good backup for the government. Now, the problem is if they did not use those for medical purposes. If you ask and they have a 1099 SA and they say, I had a great deal for either Black Friday or Cyber Monday, and that big flat screen TV I was looking at was on sale, and I knew I had money in my HSA. Well, that's a problem. It's a problem because taking money out of the HSA is not only taxable an event, it's also a 20% penalty. Now, back when we talked about income, we mentioned about the 1099-R, and I mentioned about that early withdrawal from your retirement account was at 10%, and that sounded pretty bad at the time. Doesn't sound so bad when we talk about a 20% penalty on the HSA. These are designed to be eligible for healthcare costs only. So we really do not encourage people to take money out of their HSAs. Honestly, it's pretty tough to do that. They have to request money from the HSA account and basically have no documentation of why they're taking the amount out. So we don't really see many of those. At least I haven't seen many in my practice. Hopefully it's not a common situation here in VITA. There are some penalty exceptions that do apply. If they're dead, you don't have to worry about it. They don't have to worry about it. You're taking out on account of their death. Could be disability, or if they've reached age 65, we also have some flexibility to take it out without penalty as well. How are we doing in the HSA? Any questions on that? Okay.
Question.
Oh, yes. Sorry, question.
Your slide says for qualified medical expenses during the year.
Yeah.
But you can also use prior year medical expenses.
Yes, you can also use prior year medical expenses to the extent you did not include those on the prior year. So if you have any medical costs from a prior year that you did not already include in that calculation, that's okay. So we're not able to take it for, say, if you had a $1,000 doctor bill in 2024, you can't use that $1,000 for 2024 and then use that same $1,000 again in 2025. But you could pick one of those years to use that.
That's correct. Some financial advisors suggest paying your medical expenses out of pocket and accruing those costs and then cashing them in at a later date. And I don't think there's a statute of limitations on how far back you can.
Yeah, there's technically not a statute of limitations for how far you can go back. So the question is, how far can you go back? So there's no statute under the tax code. However, you'd have to have all those receipts to prove that process. I imagine that could work if you have sufficient funds to pay your medical bills as is, and you're having such a great rate of return in the HSA that you just allow that to grow and accumulate. So that is a valid strategy that we can see with financial planning. Typically with our VITA clients, they're probably tapping into that right away. But the HSA can work. It's a great program to be able to pay for things, so it doesn't necessarily have to be going directly to a doctor. If you want to have your orthodontics paid, that could be a great way to do it as well. So maybe a solution is someone goes ahead and goes on a payment plan with their kids to get braces, and then they go and take money out of the HSA once it gets to an achievable level. And the reason for this is typically the HSA is funded with payroll deduction. So if you want to put in, say, $2,400 a year, your payroll may be deducting only $100 per pay. And we may not have sufficient money to be built up to go ahead and cover the medical costs until later, so it allows for that reimbursement at a later date. So that's a great point, though, that we do have the ability to look back with those medical costs. Wonderful. So again, the majority in VITA, what I'm anticipating we'll see is people having the W-2 with the code W in box 12. That's going to indicate a pre-tax contribution to the HSA. So we will not want to include that again as an additional contribution. That's already factored in and should be showing up on the form 8889. If they do make an additional contribution, that is entirely permissible. That would be a deduction not only for federal purposes, but one of the few state deductions we're going to have as well. So making a contribution to an HSA is also deductible for state purposes, but that has to be done with after-tax dollars. So again, if someone wants to make an additional contribution, they can do so. We just need to keep record of that and let them basically keep that documentation. Typically, there's a form 5498 that'll show contributions to plans. That's usually a quick way to reconcile. But if you have questions with the HSAs, by all means, ask someone. Usually your site coordinators are all certified at the advanced level, and we've seen a number of these issues to deal with those HSAs. Okay. Other questions? Yes?
Yeah, I missed it, but does the HSA cover like Medicare premiums or Medigap premiums?
So there are some restrictions on what it can cover. So we have a whole list within the 4012 of what it typically covers. There is, and I don't know if I brought the materials with me, in terms of medical insurance, there's only a couple insurance programs that it's going to allow you to pay for. Long-term care insurance is one, so if you actually can pay your long-term care premiums with HSA, but it's a little bit more restrictive on being able to pay for other insurance or Medigap coverage insurance. But typically, most other medical expenses are going to be allowed. So we probably just want to double check specifically what they're using the funds for. But the HSA is a wonderful planning tool, one we use quite a bit, particularly with people who do not want to pay a high monthly premium for insurance they may not use. So it gives them the ability to pay a lower cost each month and potentially put that additional amount into savings. Great plan, one that we highly encourage if people are already participating. Okay, a couple other things we want to kind of mention here for alimony. As we mentioned, alimony is potentially taxable, which means it's also potentially deductible. So what we typically have in the tax system is a mirroring approach. If one party gets to take a tax deduction, generally another party has to pick that up as taxable income. And that same thing holds true for alimony. Now, alimony had a massive change back for divorces that occurred after 2018. So any divorces that happened from January 1, 2019, or were substantially modified from a prior divorce, any of those payments will not be taxable to the recipient, will not be deductible by the person making the payments. But any divorces that happened prior to 2019, between 1984 and 2019, can be deductible by the person making the payment and includable in income by the recipient. Generally, the easiest way we can determine this is if they already had a prior year return. Again, these are not new divorces. So if they've been getting alimony since 2018 or earlier, that should be on a prior year return. We don't usually have gaps in alimony. So one of the surest ways is to go take a look at the prior year return. So I'll go through a quick definition here of what alimony is. So we have to meet all of these qualifications. The biggest one is going to be required by a divorce or separation agreement. So it's going to be a court-ordered payment. The second one is always unique here, that the payer and the recipient don't file a married filing jointly return. I'm not sure who asked that question to say if I'm paying alimony to my spouse that I'm still married to, can I take a deduction while she includes it in income? Sure, it's on the same return. It doesn't make any sense, but yet that's our second rule. So I wanted to ask that enough for the IRS to say, you know what, let's go ahead and put this in as a hard and fast rule. You cannot deduct alimony if you're married filing jointly with the person receiving alimony. Not quite sure how we got there. But alimony typically is going to be made in cash or cash equivalents. This is always fun too. For those of you who enjoy the English language, I highly recommend staying away from the tax code. There's a lot of intricacies in there, including double negatives. So the payment isn't designated as not alimony. Great. So what we're basically saying is you either designate it as alimony or you don't have anywhere in there that says, hey, this is not alimony. But that's basically the position we take a look at. As long as it doesn't say it's not alimony, we're okay. Again, a lot of these rules are already carrying over. We've seen this now for since at least 2018, so we're already 7 years in at minimum with these alimony issues. So a couple other things, that they're actually legally separated or divorced, that the payments are not required after the death of the recipient, and we're not being treated as child support. Again, so we're going to see that happen when we take a look at any divorces that occurred before January 2019. So again, should be a carryover approach here. Any questions on alimony? Okay, hopefully we don't have too many more of those. Continuing, if we do, it's pretty much the same as last year. No major changes there. Another one we don't have a major change is our IRA deduction. So IRA deductions are an opportunity for individuals to contribute to their own retirement plan. So something we may see a bit, particularly in VITA, we may have individuals who have multiple part-time jobs, so they're not actually qualified under the employer plan to participate in a 401k or a 403b. If they're interested in making a contribution to their own retirement plan, they can certainly do so. This is a great opportunity to take a look at getting a deduction while contributing to an IRA. So back in 2020, they actually eliminated the 70.5 age rule. So now any individual with earned income can make a contribution to an IRA. So that includes someone, if you're 82 years of age and you decided what better way to spend some time than put on a Walmart vest and greet people at the door, make a couple dollars, great, you have some earned income. Now you can actually contribute to an IRA. So the contributions are going to be made by April 15th. So if that date looks familiar to people, that's the due date of the return. So up until the due date of the return, you can make an IRA contribution. Now the levels have stayed the same here. They're still $7,000 per individual for 2025, but we do get another $1,000 bonus. Now these always kind of are unique. It's 55 for the HSA. It's all the way down to 50 for the IRA. So if you're age 50 or older, you get an extra $1,000, and actually has a great benefit. If you are married filing jointly, you can use your spouse's earned income to contribute to an IRA. So a technique we sometimes see in planning is we may have an individual who may not be covered by a retirement plan. Their spouse is working, and we can actually use those spouse's earnings to go ahead and contribute for the non-working spouse. So not that we're going to get you into financial planning while you're sitting here at VITA. We already ask enough of you as it is, but we just want to make sure that you understand some of the IRA rules. Now, if an individual is already covered by a retirement plan, there are going to be some limitations. Typically, they don't come into play for our VITA clients because their income is low enough that we don't have those same issues. But just go ahead and take a look at the box 13 of the W-2. That's going to indicate whether or not the individual is participating or eligible to participate in a retirement plan. So there'll be 3 check boxes there. One will say retirement plan. When you enter the W-2, just make sure that that check box is marked, and the system will go ahead and do the appropriate calculations. Yes?
One thing with the IRA, we may not see it as much now, but when they had the Obama penalty, we used the spousal IRA, and it reduced their penalty because they had like a $14,000 tax bill.
Yep. So that's a great point. I've used that as well. Some of these deductions I'm talking about now are a great way for us to what I call do after calendar year tax planning. It's a great way for us to still get a deduction before we file the return. So the question involves about the income level, particularly for people who have insurance through the marketplace. So if they go ahead and they have a repayment penalty, basically that they have to repay most of their advanced premium credit, a great way to take a look at reducing their income is using an IRA if they have the available cash. So we can use an IRA to go ahead and reduce their taxable income, potentially get them below that repayment level. And I've done that as well. For brand new volunteers, I don't want to give you any horror stories, but I have done that on the evening of April 15th before with a client, not through VITA. This is my own fault for doing a favor for a friend. And this was a situation where they said, oh, my return should be easy this year. That's generally your first sign it is anything but easy when they think it's going to be easy and they don't want to do it themselves. But I had a similar situation. I had a client who had an unexpected windfall of income. She took money out of a retirement account, and it was the way that she had gotten money from her deceased husband created a higher amount of income. So what we ended up doing was taking a look here and realized if we use an IRA, we can now get her income beneath the filing penalty for her Medicare, not her Medicare, her healthcare premium. And I'll talk about the healthcare premium a little bit later today. But it's a great planning technique. If people owe a lot of money and they have some available cash, they can do this up to April 15 to go ahead and make that contribution. So just as a back-end planning technique. Okay, great question there on the IRA though. Any other thoughts or questions on the IRAs? Okay, let's move over to another one that is popular. It's the student loan interest deduction. So this is going to be a opportunity. Again, the AGI limitation does not apply to VITA clients, so we don't need to worry about any phase outs. Typically, an individual is going to get a Form 1098E. That's going to report their student loan interest paid. Now, it's important to know that the interest is only going to be deductible by an individual who is liable to pay the debt. So if someone's going ahead and paying your student debt for you, that is incredibly generous, but that doesn't mean that they get the ability to deduct the loan interest. So if a grandparent decides they want to help out their grandchild and pay off their student debt, and they present a 1098E and say, here is the debt I'm paying off for my grandchild, we have to understand, are they legally liable for the debt? That's one of our basic premise here, is they have to be legally obligated to pay the debt. If they are not, then the way the tax code is treated is that it is a gift to the individual who was liable to pay the debt. And that individual can then make that deduction. So the grandchild, if they're the ones who were supposed to pay the debt, but the grandparent paid it, the grandchild can then take that student loan interest on their return if eligible. So student loan interest, we can take up to $2,500 or the amount of interest paid, whichever is lower. And just a couple other things we have. We may have mentioned this a couple times during our which filing status should I pick. Married filing separately, you'll see a lot of times popping up here and not in a positive way. So if you're married filing separately, you cannot take the student loan interest deduction. So just a caveat in there to take a look. But generally, when we take a look here, the student loan interest, relatively straightforward. We'll get the 1098E. We just need to double check whether or not that individual was legally responsible to pay the debt. There is one change that happened back a couple years ago that you can actually use up to $10,000 from your Section 529 plan to pay for student loan debt. So it's a one-time only, not an annual amount. But if people have money in a Section 529 plan, they can take up to $10,000 to pay for principal and interest off a student loan. Okay, how are we feeling on the deductions? These are the common ones we have. You're thinking, wait a minute, I thought I heard about some new ones. We will definitely get to those. Those will be at the end. They are not in your 4012 right now, but these are also going to be some brand new deductions. But I'm going to save those for the end just because we'll have a little bit of sizzle at the end of the presentation here today, hopefully. And I'm anticipating more questions without maybe a ton of answers that we have at that point. But here's what's kind of nice. Deductions are good. Deductions are good because they're going to help us reduce our taxable income. But what's more exciting than a deduction are credits. Credits are actually going to reduce our tax liability dollar for dollar. A deduction only reduces our income dollar for dollar. So the benefit we have of a credit is that we can actually reduce and potentially have a refund. Now we're going to start with the good ones, not the great ones, because these are non-refundable, meaning that these credits can help take your tax liability down to zero, which means you don't have to pay any tax for that year. You can still get a refund of any amount that you had withheld or any other potential opportunities. We'll talk about some of these non-refundable credits. One of the first ones we have is a foreign tax credit. Now, not applicable to every taxpayer, but if they have investment in foreign, whether a bank account or whether a stock or an investment fund, typically we may see that they have a foreign tax paid. Usually I'll find these off a 1099 form, usually a 1099 DIV or some other type of form, 1099 INT. As long as that amount is less than $300 per taxpayer, we can enter that on TaxSlayer and it'll automatically take that deduction, the credit for us. No other information is needed. We do not have to fill out a complex Form 1116. Those are not a lot of fun, but for most cases for our taxpayers, they'll probably be beneath that $300 per taxpayer threshold. So if we see that, we just simply enter that information. We'll talk about a couple more of these as well, including the credit for child and dependent care. We'll have a retirement savers credit. The good part about that retirement savers credit, that one's pretty much an automatic calculation. There's one other area we're going to have to inquire about, but for the most part, that one's going to be fairly straightforward. We're also going to talk about education credits, which are incredibly popular, and as well, the last time potentially we'll see the energy credits. We'll give you some updates on what's going on there. So I want to first talk about the credit for child and dependent care. The credit had bounced around the last couple of years between fully refundable and non-refundable. We're back in the non-refundable category. It's considered non-refundable. The good news, however, for those of you who have been volunteering for a little while, we had some PA changes a couple years ago, one of which is the credit for child and dependent care is now a PA credit as well. That kind of popped up a couple years ago between the time that we had our session and the time we actually filed returns. But that is also eligible for PA. If you're eligible for federal, that'll automatically carry over to PA as well. Now, the credits we take a look at, it's up to $3,000 qualifying expenses. For one child, up to $6,000 if you have two or more. For anyone who's priced childcare lately, that's not a hard threshold to get to. $3,000 is not unreasonable for care expenses. There are a couple little unique issues. This credit's pretty much available for almost any taxpayer, particularly those within VITA. We're going to see a phase out for any AGI above $400,000, but we're probably not going to see them coming through the VITA program. We'll probably be somewhere between 50 and 35%. Again, this will be automatically calculated by the tax system. You don't have to memorize any of these numbers. You don't have to do any of the calculations by hand. But there's a couple important things we have to do to fill out these forms. This will be on the form 2441. So typically what will happen is we'll need to get a couple different pieces of information from the client. One important thing to take a look at, the W-2, and it's something I have to remind myself of every time I prepare a tax return, is to take a look at box 10 of the W-2. Depending how the W-2 is presented, it may be a little bit offset. It won't be with all the other information you're kind of muscle memory looking at there, the boxes 1 through 6. But box 10 is actually child care expenses that have been paid through an employer type of account. So this could be a flex spending account or something else. We just want to double check that. That's going to reduce the amount that you have eligible for your child and dependent care credit. Now I'll go through some of the eligibility rules. So these haven't changed, which is good because it gives us a little bit of consistency. So for the eligibility rules, we're looking at one or more qualifying persons. So the big thing is we want to take a look at what's the definition of child, and that's always a fun thing to ask. What does the IRS mean when we talk about child? Because we've already talked about a couple different definitions. We've talked about the credit for a child. We're going to talk about what a child means for education purposes. What a child means here for child and dependent care is someone under the age of 13. Okay, that makes a little bit more sense. In the IRS's world, once you turn 13, you know everything. You don't need any help. You're good at making your own mac and cheese in the microwave. You're okay. You know how to get a snack. You can raise yourself. According to most 13-year-olds who now have cell phones and have access to anything they want. But the IRS's view is if you're not a teenager yet, that you probably need some additional care. Now, what's unique about the child care, it's only for the custodial parent. So when we talked about dependency, we had the opportunity for a non-custodial parent to claim the child for dependency purposes. But for the child care and dependent credit, it's only the custodial parent that's supposed to take the deduction for any child care, because they're the ones that actually have the child under custody. So only the custodial parent is supposed to take the child independent care credit. So that's one definition. We have a child under the age of 13. Once they turn 13, we can no longer take that cost. That doesn't mean they may stop going to daycare or have some kind of care program, but we can take it up until the age they turn 13. Now, what's kind of nice about the program, that could include any before or after school care, particularly for children who are off at school and their parents are working. That also includes camp programs as well. So if you want to send your kid off to soccer camp or space camp, as long as it's not an overnight camp, those costs can qualify. So as long as we have a couple different things, we need to have the employer identification number or social security number of the person providing care. That is critical. We need to have that information, the person providing the care, and the amount paid. So we may have a scenario where someone may say, I do have someone who takes care of my child after school. It's a kindly neighbor down the street. I pay her a couple $100 cash each week. And you say, great, we have the potential to take this as a credit. Do you happen to know her name and social security number? Well, she's not going to provide her social security number. Okay, well, that's an issue on that side for a different day. What basically is happening is we're probably going to have an individual who doesn't want to report the fact that they have child care income. But we cannot take the credit without having that information. We need to have the social security number or EIN of the institution or individual providing care. So again, same concept. The IRS is going to give a deduction on one hand, but they want the individual providing care to report the income on their return. So just a matching concept. We could have, in addition to a child, it could be a dependent of the taxpayer who's physically or mentally incapable of caring for themselves and lives in the same place as the taxpayer for at least half the year. What we basically mean about incapable of self-care means someone who may need assistance with either dressing, cleaning, or feeding themselves. Someone who needs some additional assistance. Or if they need additional care because they may be in a self-harm or have the possibility of injuring themselves. That can also count as well. So it also includes a taxpayer's spouse who's not able to take care of themselves as well. And again, as long as they lived in the home for at least half the year. So generally, we need to have both taxpayers, if they're married, to have income because it's intended for the care of the child or dependent while the spouse is actively working. There are some exceptions, which include if the spouse is themselves incapacitated or if they're pursuing education. There are some exceptions to that rule. How are we feeling on the child independent care? Any questions there? Okay. All right. We'll go to one of the automatic ones here. Retirement Savers Credit. So Retirement Savers Credit is allowing the opportunity for taxpayers to effectively get a credit for contributing money to their own retirement plan. So this could include a traditional IRA, which we just talked about. It also includes a Roth IRA. So a Roth IRA is a bit unique. You didn't get a tax deduction for the money going in, but your amount received should be tax-free coming back out. The government will still allow that to be considered a contribution to a retirement plan for the Retirement Savers Credit. Also includes the elective deferrals to a 401k or 403b or a government 457 SEP or simple. So how do we find this? Well, the good news is for the most part, this is going to be found on your W-2s. So if you take a look at your W-2 box 12, I have what looks like an alphabet soup up here. These are the codes that are automatically going to go ahead and calculate for the form 8880. So it's a D, an E, an F, a G, an H, an S, a double A, a double B, or a double E. Those are all employer-sponsored type plans that are eligible for the Retirement Savers Credit. If you are calculating an IRA for the contribution, that will automatically be included in the Form 8880. The thing that you have to do manually is if someone's made a Roth contribution, the tax system doesn't know it made a Roth contribution. So you do have to enter that manually to be able to get this Retirement Savers Credit. Now, couple of the rules. You cannot be a dependent or a full-time student and take advantage of this. You also have to be born before January 2nd of 2008. So issue number 2 with Congress is apparently they normally like to do things at the end of the year. Except I imagine there's someone in Congress or a senator who they themselves or a family member was born on New Year's Day. And they felt, you know what, we've gotten all the short side of things here. We're kind of a year behind everyone else. Our birthday's usually celebrated with pork and sauerkraut here in central PA. Maybe not our favorite meal, but we'll give you a break. If you're born on January 1, we actually get to advance you 1 year to take this retirement savers credit. This gives you one opportunity. Again, you don't have to worry about birthdays. We already have it in there. So the one thing we also have to take a look at is we are a little bit inquiring about whether or not they made any withdrawals from their retirement account. So if they made a withdrawal from their retirement account in the prior 2 taxable years or up until the due date of the return, we have to reduce that amount for the eligible credit. The government doesn't want you to put money in your account, take money out of your account, putting money back in, and then say, oh, can I get a credit on the new contribution? No. This is intended for people to put money in and keep it in their account. So they're going to reduce by any amount of withdrawals. Generally, we can find that by taking a look at prior year returns. That 1099-R is going to be our clear sign of whether or not they had any withdrawals from their retirement accounts. So what we look at is this can work for any pre-tax money that you're putting in, your 401k, 403b, those types of things. Also, any voluntary after-tax contributions can count as well. So one of the big questions we have here is what happens with PSERS? So PSERS, it's only the voluntary after-tax contributions that will count for the purposes of the credit. So PSERS normally has a mandatory contribution, but what we also have is the ability for individuals, particularly in education, to contribute an additional voluntary amount. It's that additional voluntary amount that would be qualifying for the 8880. So that can be changed at any point in time. That's the PSERS direct contribution plan. So what we take a look at, generally that may be found in box 14 of the W-2. So if the contribution qualifies, you can actually have TaxSlayer carry that over. So if you go to the drop-down menu in box 14 of the W-2, you can select a retirement not in box 12 to carry to the 8880. So as long as you're eligible, we can go ahead and have that carry over. So if you have any questions, feel free to ask to make sure we're doing the things the right way. Yes, sir.
In general, though, the PSERS that you've seen, how common is that? I mean, is that
It's probably not as common. So the question is, how common is an after-tax voluntary contribution to PSERS? Generally not that common. Most of these are going to be our traditional mandatory deferred PSERS contributions. But you can ask, did you elect a voluntary contribution to PSERS? So that'll be how we determine whether or not it's technically eligible for the 8880.
And will the clients, do you think they will know, or are they just going to answer, yes, it was voluntary?
The client should hopefully know, because it's something they have to elect each year with their HR. That typically that they're going to go ahead and say, I want an additional amount withheld from my pay to go to my direct contribution plan. So hopefully they should know that answer. And if they don't know the answer, we don't know, then we can say, okay, unless you can tell us how much it is, we can't use it. So yeah, generally we'll have to ask. Okay. Other questions on retirement? Yes, ma'am.
It's not on retirement.
Okay.
Does with VITA, if you put the Social Security number in when you're starting the thing, it automatically pulls up the previous years?
So it's a great question. So yes, so the question is, if you enter a brand new return, you put the Social Security number in. If the client had been at that site before, and I think depending on our setting, it will ask, do you want to pull the information from the prior year return? The answer is generally yes, because it means you have a lot less typing to do. So I think that might be more of a question from an administrative role, but generally if they have been in the same site before, we put the Social Security number and it's automatically going to pull the prior year if you wanted to, which is great because it means that it's less we have to enter in for W-2s or 1099-Rs or even just basic information. Unless you'd like to practice typing, I suggest always have it roll over from the prior year. We can always delete the things that don't apply from the prior year. But generally, yes, it should carry over from the prior year. Okay. All right. Want to cover one of our other non-refundable credits. This is going to be our energy credit. This has some changes to it this year. In prior years, these were extended all the way through 2032. Under the new tax code, these are all going to expire at the end of this year. So at the end of 2025, we're going to go ahead and lose the residential clean energy credit and also the energy efficient home improvement credit. So 2 credits. The first one I mentioned, the residential clean energy credit. This is where we're going to be talking about people putting in solar, wind turbines, any type of geothermal. This is technically out of scope for VITA. This is a pretty nice credit. It works great for people who have done solar. You get a 30% of the cost of the project. So it does work. We have very, very high ability to deduct this. So people with higher AGI, it's a tremendous credit to use. If you're interested in it, you still have 28 days to go ahead and get it signed and installed. If you are a homeowner, you may have noticed people knocking on your door telling you we'll put solar in for you. I'll let you decide whether or not you want to go with a roving salesperson trying to sell you solar. But if you do put it in, up to 30% of the cost of that project can be deductible. Unfortunately, not going to be applicable under the VITA program. What is, however, is the second part, which is the energy efficient improvement credit. So this actually has a couple different components. We can take up to $3,200 per year if you're meeting all of these qualifications. Now, an important change for 2025 is we now have to have a qualified manufacturer identification number called a QM code or a PIN for most of these items. For those of you in the past that have done this, we're looking at things like energy efficient improvements, like things like replacement windows, HVAC systems, insulation, that type of thing. In the past, we just had to put down the cost, and it was typically the cost of the material, not including labor. But now the Form 5695 has been expanded, and now they have a code that you need to put in to match to these specific units. I guess the IRS realized there were many people who just said, sure, I put brand new windows in. Who's going to check to see if I spent $600 on new windows? Well, now you have to actually enter the code that comes with that energy efficient property. So when we have clients who may say, I put in a brand new HVAC system or I put in brand new windows, now there's a little bit more work involved to make sure that we have all that required information. So hopefully they have gotten that from their contractor, or if they've done it themselves, hopefully they kept the documentation that we have that QM code or PIN. Because if you go to the 5695 this year, it does have the area that we need to enter that. So what we basically take a look at is you can get credit for common items like your non-solar water heaters, HVAC systems, biomass stoves, exterior windows and doors, and insulation. Those are the predominant ones we see. You also can have up to $2,000 if you put a heat pump or biomass stove in as well. Most clients probably know that they have this. They probably were told by their contractor, you're going to get a credit if you go ahead and go through the process. So most times they'll probably come in and say, oh, by the way, I had some improvements done to my house. So these are literal improvements. They can't be for the new construction. So you can't put a brand new home in and say, oh, let me deduct my HVAC. That doesn't count. It's only for energy efficient replacement property. So again, a couple different changes here for 2025. We need that QM code. And this is the last time under the current tax code that we'll be allowed to take these credits. Okay. Any questions on the energy credit so far? Yes, sir.
Is it still the same that if they got a rebate when they put it in, you have to deduct the rebate from?
Right. So great question about what happens if they get a rebate. So oftentimes you may either have a state rebate, or oftentimes the utility companies, PP&L, UGI may be running rebates if you put energy efficient programs in. Technically, the cost of the rebate should reduce the amount that you paid for the property. So you should be reducing the cost, you should theoretically reduce the cost that you're paying by the rebate you receive, much like if you're getting a discount or rebate on anything else. So theoretically, you shouldn't double dip and say, I'll take the rebate from the utility company and also use that same cost for the federal side. In most cases, we're probably going to be above the limits. If anyone's priced replacement windows as of late, they're not inexpensive. So like everything else, they're going up in price. So hopefully we're still above the thresholds. Yes?
This is probably unique, but what if you get somebody that they're not replacing the HVAC system, the residents never had that and they put it in? Existing residence,
Yeah.
new functionality.
Okay. So if the home so the home's been there for a while, that should qualify. The basic premise is they don't want new construction. So if you build a brand new home and you're putting an HVAC unit in, they don't want you to be able to take a credit for a brand new unit. If you're, maybe you're going and putting in a brand new system in because the home never had HVAC, that should be a qualifying element. So you're okay as long as the home has been existing. That's our biggest issue, taking a look at whether or not the home was built previously or whether it's a brand new construction. New construction's out of the picture altogether. Yeah. Yep, great question. Okay. Moving on to energy, from energy to education. Good news is that these credits are still very popular. They haven't had any changes over the past couple years. We have two credits that are generally available for education purposes. One is the American Opportunity Credit. The other is the Lifetime Learning Credit. Very, very similar in their approach, but different in their impact. So credit eligibility would be the taxpayer, the spouse, or any dependents claimed on the return who attended a post-secondary education. So in general, what we'll typically see is a parent whose child is at college, and we're going to try and take the credit on their return. Another one, we can't take this if you're married filing separately. So it has to be a married filing joint return if you are married. Qualifying expenses include tuition, also includes any certain required costs for education or enrollment. So that could be lab fees, any other type of required fees by the institution. We'll take a look at some things that are non-qualifying, so that's room and board, any of your personal living or travel expenses. That includes most individuals are probably going to go ahead and purchase brand new college gear. I know most of my students all have their proudly wearing their brand new college sweatshirts and t-shirts. Those are not deductible. Those are just personal living wear, although the bookstore thanks you for your support, particularly for the parents that proudly wear those as well. So we're going to take a look at qualifying expenses. Now, the good news is that this actually kicks in for very, very low cost. We don't need a whole lot of expenses to be able to qualify for the education credit. And for those of you who've ever paid a college tuition bill, they're not inexpensive. What we're going to take a look at is anything paid in the current year. So anything you paid in 2025 for any 2025 education, or if you are paying now for next semester. So typically a college will start sending out bills for their 2026 semester now. So if you pay a bill for the 2026 year in December of 2025, you can still count that on your 2025 return. And there's a very valid reason why we're going to see that in a little bit. So in order to claim the credit, again, it has to be the taxpayer, spouse, or dependent children. If for some reason the taxpayer doesn't claim the dependent on their return, maybe they're not getting a benefit for the child, maybe their AGI is too high, then the dependent can claim the education credit if applicable. The downside is typically at that point, if you're a college student, you may not even have enough taxable income to warrant the credit. But we may see a partially refundable one here, so it may be worthwhile. Generally outside VITA, but you may have a situation where parents are their AGI is too high to take either the credit or take much advantage of the child as a dependent. So there might be an advantage for them not taking the child and the child to take the credit themselves. So I want to take a look at the two credits in a little bit more depth. So these are going to be our American Opportunity Credit and the Lifetime Learning. Generally, the way you're going to see that there is a credit opportunity is the taxpayer is going to receive a Form 1098-T coming from the educational institution. That information will be needed to go ahead and prepare the education credits. We're going to need the name of the institution, the employer identification number, the address, and a couple other pieces off that Form 1098-T. Good news is the payments are going to count with whether they're cash, whether they're credit cards, whether they're even borrowed funds. So you can take out a student loan to pay for your college costs and still use those funds for the credit purpose. Now, you do have to reduce your cost by any qualified tuition or any other type, qualified scholarship or any other tuition reduction payment. If someone else is paying your tuition, you can actually count those costs for you as well. Similar to that student loan interest, if a grandparent's paying your tuition you can actually go ahead and use their payment to count for your credit. So, so if the student's a dependent, then the funds are going to be treated like the parent had paid for them. For the American Opportunity Credit, this is our most powerful one that we have. Credit up to $2,500, of which we can actually have up to $1,000 be refundable, even if the student has no tax liability, or the taxpayer has no tax liability. This is based on your first $4,000 of tuition. And if you thought childcare was expensive, it's not that hard to get to $4,000 of tuition. Believe me, someone who's in education, I know how much they charge for these things. Here are the rules for the American Opportunity Credit. It's only allowed for the first 4 years of qualified education. So your first 4 years of post-secondary education. Now, the expenses are going to include any of your course material, tuition. That includes books, supplies, and any equipment needed for your field of study. So if you have to buy books, it doesn't matter where you buy them from. If you have to buy a computer or device to attend a school or a program, that qualifies as well. Any of those tuition costs. So again, not hard to get to $4,000. As I mentioned, up to 40% of that can be refundable, so that's up to $1,000, even if you have no federal tax due. You have to be enrolled in a program that leads to a degree or certification at least half of your normal workload. So the Form 1098-T will have a little checkbox at the bottom that says, check if the student's at least half time. So that means typically they'll probably be enrolled in, depending on the institution, it might be 12 credits. It's all going to be on the institution's definition of what they mean by at least half time. So generally shouldn't be that difficult to go ahead and get up to $4,000. Here is the interesting part. The one time we have to ask a question that might be a little bit more sensitive. The student may not have a felony drug conviction. So we've already talked about Congress apparently having an issue with phys ed teachers and health teachers. Don't want to feel slighted for people born on New Year's Day. But also someone in Congress said there is absolutely no way I'm going to allow someone who's been convicted of a felony drug conviction to benefit from this American Opportunity Credit. Other felonies are fine. We're okay with that. If you have kidnapping, extortion, murder, high treason, you're okay. You deserve a second shot, but not drug conviction. That's apparently as far as Congress would take it. So we do have to ask the question, and the question is, as of the time of the filing, have you been convicted of a felony drug conviction? So hopefully you don't get a whole list of questions of the individuals giving you a list of their rap sheet and saying, does this count or not? It's a felony drug conviction. It's a fairly serious charge. It's not that you got caught doing something you're not supposed to do at the playground, right? This is not that situation. This is a felony drug conviction, and you have to be convicted. There may still be time for a pardon before you file the return if you want to try and go that route, but it's a felony drug conviction. If you have that, you cannot qualify for the American Opportunity Credit. But the good news is you can then qualify for a second credit. Now, the reason I mention about the 4-year rule is that it only works for the first 4 years of undergraduate education. The problem we run into is that your first 4 years of undergraduate education typically spans 5 calendar years. Most individuals will graduate in May or June of high school and then matriculate in August of the following year to school. Well, your first year covers actually 2 calendar years. So the academic year is going to cover actually multiple years. But the reason why we talk about that payment of tuition in the end of the current year for the next semester, typically you're going to pay your tuition over 4 calendar years. So if someone matriculated to school in 2025, they're probably going to pay their fall 2025 tuition in 2025. They're probably going to pay their spring 2026 also in 2025. So that 4 years is pretty much going to cover your 4 years of payment, even though they're going to probably finish up school in a 5th calendar year. Now, if they've exceeded that 4-year rule, if you have an institution or a child who loves to go on the 7-year plan, again, as an educator, I don't mind seeing them for a couple times throughout their career. Most times you can get your bachelor's in less than 7 years, but if someone wants to take a longer route to get there, that's entirely fine. Or if you go back to graduate school, or if someone wants to just pick up a random course. We have what's called the Lifetime Learning Credit. This is non-refundable. This is up to $2,000 of a credit based on 20% of every dollar you have up to $10,000. So pretty much tuition only. No number of years that this can be claimed for. You can be convicted of anything that you want. Treason, piracy, it doesn't matter. You can take this credit. It's only going to count for tuition. It's going to be for books, supplies, fees, and other equipment if they're purchased through the institution. So the difference between the American Opportunity Credit, if you want to go out to Amazon or some other place to buy your textbooks, that's fine. For the Lifetime Learning, those textbooks have to be purchased through the bookstore. So they typically have to be purchased through the institution. Again, no requirement for half-time enrollment, and again, any conviction is fine. Yes, sir.
What about if you go to massage therapy school or cosmetology or barber?
So what we have to take a look at, these would be considered qualified institutions by the Department of Education. So they have to be leading to a degree, program, or certification. So typically things like a Thaddeus Stevens would work, but typically not a Champs Barbershop would work in that context. So typically they have to lead to a higher degree. So some sort of program that's going to go and award an associate's or some other type of degreed program.
But you got to be licensed to do that in the state of Pennsylvania, so you have to take the course, right?
Yes. So that's a unique question of how that can work. Are you referring specifically for Lifetime Learning?
Either one.
Yeah, so the American Opportunity is a little bit more restrictive, obviously because we need to make sure that that is a Department of Education qualified institution. So typically one that we'd see leading to a degreed program. So there's a difference between a certification program and a degreed program. So we probably will not be able to qualify the beautician school as a American Opportunity credit. We'd probably take a look at the institution depending on what they do. If they do become certified with the Department of Education, then they should be eligible for these credits. But we have to take a look at the individual institution. But if you and I, John, want to open like a sailing school or a surfing school, we probably would not be able to get that to work. We could try. I mean, that could be possible. But yeah, typically it has to lead to a degreed program, not just a certification program. So again, Department of Education should have a list of all the institutions that are approved and eligible. Okay. Yes. Yeah, go ahead.
Are you saying that the American Opportunity Credit needs to be 4 consecutive years, or does it just need to be 4 educational years?
It's 4 educational years. So the question was, does the American Opportunity Credit have to be 4 consecutive? The answer is no. It's just the first 4. So typically we may see someone who has gone and gotten an associate's degree and then gone back later to finish off a bachelor's degree. That's entirely fine. It just is the first 4 years of education. So that's entirely possible for someone to do 4 years over a span of a couple years. And typically, I think we may see it. Someone may go to a community college, get an associate's degree, and then go back and complete their bachelor's degree later. That's entirely acceptable. So it's the first 4 years of post-secondary, not calendar years. That also includes if someone takes a gap year, if they go off and do something else. It doesn't mean it's consecutive years from the date that they graduate high school. Yes.
I had a situation last year where a low-income student got scholarship money that covered room and board, and then this was counted as income for the parent, and it led to a significant tax liability. Is there any way to minimize that? I mean, the mom was really surprised.
Yeah, so typically the way that scholarships work is they would be considered tax-free to the extent that they're going to pay for qualified education expenses. So that typically means that would be considered your tuition and a couple other related expenses. If they're getting effectively a full ride scholarship, it means that they're being covered for room and board, potentially meal plans and some other activities. So unfortunately, those are traditionally going to be considered taxable income in that environment if they're exceeding the allowable exclusion amount. We may be able to take a look to see if how many more programs could qualify, how much expenses do they have, but it's really taking a look to see how much did they receive and how much was actually spent directly toward the education piece. And I have run into this situation before. I've represented some student athletes that are getting full ride Hopefully we don't have to worry about NIL money here. I don't think anyone's getting that kind of money here at local institutions. I have had to deal with that before, but that's considered taxable income because it's in excess of the amount used for education.
Would it possibly beneficial if the student was not claiming the dependent and filed, individually?
So
that was their income?
Yeah, so part of what we could take a look at is whether the filing status could benefit. It could be that because if the student doesn't have any other income, we take a look at their standard deduction. This year it's up over $15,000, so that could actually absorb most of the taxable scholarship. So that could be an option to go ahead and treat it as earned by the student. Again, we could probably take a look to see if it's considered taxable scholarship, then the student may actually be providing more than half their support. So it could actually get us to the point where we could actually legitimately claim them as a individual taxpayer not dependent on their parents. So that could be an option as well. Yep, so definitely some planning techniques. And as a general rule, if you run into situations where the return is not what you were expecting, or the client says, oh, you've gone from the green part, which is good, meaning I'm getting a refund, to that red thing up in the corner, which means I owe money, we can pause it. They're probably not in any anxious nature to say, let's go ahead and pay this right away. We can take a look and come up with some optimal solutions for the client to make sure we can maximize their benefit within the scope of VITA. Okay. How are we feeling so far? Okay. We ready for a quick break? I think we got a second Keurig machine out here to speed the line up a little bit. If we want to take about a 5-minute break here and then come back, talk a little bit more about some refundable credits and go through a couple more pieces here, we'll see you back in about 5. All right, welcome back, everyone. Hopefully we're getting enough caffeine and sugar to keep us ready for the second part here. So wanted to go ahead and save the best for last here for the second half of our presentation. This is, in my mind, some of the most exciting pieces, because now we're going to be talking about our refundable tax credits, which means that we can get money back for taxpayers even if they don't owe any tax. Even if they haven't paid any money into the federal government, we may be able to get them some money back. So I just want to talk a little bit more about some of those credits. We'll talk a little bit about the marketplace insurance again. Good news, no changes from the prior years, but I just want to mention a couple things, what happens with that Form 1095A, and then we'll finish in a rousing session here of new tax things that became law on July 4th that will have impact to the current year returns from a federal perspective. So just want to talk a little bit about those refundable credits. Going to go into a little bit more detail today of the child tax and credit for other dependents. Also the earned income credit, which is our most powerful credit here within VITA. And then also, just as a reminder, if people have made estimated tax payments, we want to include those on the return as well. That's going to be on the Form 1040 line 26. Hopefully, again, the 4012 doesn't change their tabs, since I went through and diligently tried to reference the tab numbers of the original 4012, but it should be on H9 if you're interested in taking a look there. So the child tax credit, we do have a change here. So with the new tax bill, they actually increased the child tax credit up to $2,200. They added another $200 to the child tax credit with the new bill passed in July, or signed in July, I should say. Same rules still apply. It's children under the age of 17. So yet another change in our rule of child per the Internal Revenue System. Child care credit is under 13. Dependency is typically under the age of 18 unless you're a full-time college student. And the child tax credit is under the age of 17. So this is one of the main reasons we'll see refunds potentially changing for individuals as their children are growing and aging. So 16, you still get the child tax credit. 17, you do not. You now drop down to a different position. And then if you go off to college, then maybe you get back into the college credit. So we generally have a gap year or two right at the time that children seem to be the most expensive. When now they have their driver's license and now want to do all kinds of other things. But according to the government, you don't need as much money for a 17-year-old as you do a 16-year-old. But that's up to $2,200. So just a couple rules. They have to be under the age of 17 at the end of the year. Again, automatically calculated within our process here within VITA. They have to be a U.S. citizen, U.S. national, or resident alien. So we just have to check on the status of the child to determine whether or not they're eligible for the child tax credit. So they have to be claimed as the dependent on the return in order to get the child tax credit. So again, the non-custodial parent may claim the child. They're going to get the child tax credit. So non-custodial parent may claim whether they have an agreement with the custodial spouse or they have that Form 8332. But the custodial parent is the only one eligible to take the child tax credit, or the child care credit, I should say. Child tax credit goes with the dependency. Child dependent care goes with the custodial parent. Every child has to have a valid Social Security number by the due date of the return. Generally, that might be a situation if we have children born near the end of the year. Hopefully they have their Social Security number issued before we actually file the return. If they don't have it, we should hold off on the return until they actually get the Social Security number. Now, there is an automatic additional child tax credit which becomes refundable. The refundable portion is up to $1,700 per child. That is going to be based on taxpayers that have earned income. If it's over $2,500, they're going to be based on the smaller 15% of the taxable earned income that's over $2,500 or the amount of unused child tax credit. Good news is you don't have to do the math. That's automatically built into the tax software. We don't have to determine whether or not they're over the $2,500 and doing the 15%. The system will automatically calculate the amount of refundable tax credit. You can also qualify, other than the earned income, if you have 3 or more children on the return. So that'll also basically add in that additional child tax credit. Now, what happens if we have a child who is 17 or maybe qualifies other dependency? So there is another credit available. It's only $500, but it's still a credit available. That would either be the dependent who is not eligible for the child tax credit or a qualified relative. So again, the qualified relative, going back to our very first session, would be anyone who qualifies under the C6 relative chart. Again, the dependent has to be a U.S. citizen, U.S. national, or resident of the U.S. So those are going to be our criteria. They also have to have a valid identification number by the due date of the return. The most common one for the credit for other dependents would be children age 17 and older, and any elderly parents are typically the ones we'll see for that additional credit. Okay, now here's the time we cue the pyrotechnics, but the church is having an event in the other room, so I think we're going to dampen it a little bit here. But the earned income credit. For those of you who have been volunteering for a while, this is one that you're probably familiar with quite a bit. This is where the majority of our refunds are going to be coming from for our VITA clients. For those of you who haven't been working VITA before, this is the exciting part. This is the earned income credit. This is an opportunity for taxpayers who are generally considered to be lower income individuals, but they actually are earning money. They have earned income. And that money can come from either wages, it can come from self-employment, it can even come from taxable long-term disability payments if they get that before retirement age. A couple other things that can count as well. Military pay can be considered non-taxable for federal, but also includable for earned income credit. And I'll talk about Medicaid waiver payments in just a minute here as well. As long as your investment income is not more than $11,950. I'm going to go out on a limb here and say I don't think we've seen anyone in VITA who's got $11,950 of investment income. Now, someone may prove me wrong at some point throughout the season, but that's a lot of interest in dividends and capital gains. Most times the individuals who qualify are not going to be day traders with a lot of investment income or substantial interest in dividends. So that is one thing that can kick a couple things out. The one reason I mention that, sometimes the certification exam loves to throw a little wrinkle in here, and it may be a situation where we have a person who looks like they should qualify, but somehow they have $14,000 of interest income. To get $14,000 of interest income, I know rates are up a little bit, but that's a substantial amount of money you have sitting in your savings account or money market. So you probably do not come to VITA if you have that kind of interest. Another opportunity, cannot file separately. I don't know if we've heard that today, sarcastically saying. Married filing separately is not a good day to be taking advantage of these credits and deductions. So earned income credit, not available if you're filing separately. In order to claim, you have to have the taxpayer and spouse must have a social security number by the filing date of the return. All children have to have a social security number to qualify. Now, if you have a child who does not have a social security number, that does not preclude you from taking the earned income credit. It precludes you from using the child to enhance your earned income credit. So it's entirely possible if you have a situation where someone says, I have a child, but they don't have a social security number, that's okay. You can still file, but you cannot use that child to help increase your earned income credit. You cannot be a qualifying child of another person, meaning that you're not going to be on a return as a dependent, and you're not previously disallowed a credit in a prior year. So earned income credit is one the government wants to be sure we're having eligible people take the credit. So if you've done something you're not supposed to do, you can get banned from claiming the earned income credit for a period of time. So the qualifying child rules are very similar to what we have for the dependency rules, except the support test doesn't apply and the residency test applies only if the child lived with the taxpayer for more than half the year. So what we're basically saying here, again, a non-custodial parent can claim the child for dependency purposes and child tax credit, but earned income credit is going to follow the individual where the child lived for more than half the year. So it's important to know that you must be a U.S. citizen or resident for the entire year to claim the earned income credit. If you do not have a qualifying child, you are not allowed to take the credit if you are under the age of 25 or over the age of 65. So a bit of a change a couple years ago. They actually waived that during COVID. We're back into the under 25, over 65 rule. A couple things I do want to point out if we mention about those Social Security cards, if we do have refugees or other individuals, if the Social Security card says valid for work only with INS or DHS authorization, they can use that number to qualify for EIC. So if their Social Security card says valid for work only with INS or DHS approval, that's okay. If their Social Security card says not valid for employment, that means that they are not eligible for EIC if they're getting other federal funding, such as Medicaid or things like that. So they cannot take EIC if their Social Security card says not valid for employment and they're receiving other federal funding. Now, what are we looking at here in terms of the opportunities? So I've updated the earned income credit again. This is all built into the system. So the first thing we have, if you have no qualifying children and your status is single, head of household, or the qualifying surviving spouse, your earned income's got to be less than $19,104. So again, the age test would apply. You have to be between 25 and 65. No eligible children. Under $19,104 of earned income, and your maximum credit's just a little over $630. But here's where the power comes in. If you have children, now, one, we remove the age test. So no longer do we have to worry about that 25 or 65 rule. And we're going to bump your eligible earned income way up. For 2025, it goes up to $50,434 with one child as a single individual. So that's almost hitting our VITA limit already. The more children you have, up to 3, the higher that amount goes in terms of our threshold, and the higher the amount of earned income credit you can get. So with 3 or more children, you're all the way up to $61,555. That means single, head of household, or qualifying surviving spouse. You can get up to almost $8,000 of a refundable credit. So that is basically refunding all the money that you put into the government plus any other credit. Now, if you're married filing jointly, those numbers go up even higher. because what that's going to take a look at is now up to $26,214. That's going to be our earned income threshold. If you earn more than that, so for example, if you're a married couple, no children, but you make $25,000 combined, you're eligible for earned income credit. If you make $27,000, you're not eligible for earned income credit. So similarly, we'll see that kind of escalation happen there with the more children you have, all the way up for married filing jointly up under just $69,000 of earned income as your threshold, which means we're actually pretty much within the full scope of VITA for married filing jointly with 3 children. The most powerful credit we have, the good news is this is automatic. So you have a lot of power with just entering the information off the W-2s, making sure we have the dependency handled correctly, relatively straightforward of a process. Any questions on earned income credit? Okay. If you do not like being hugged, you may want to sign at your desk to say, please don't hug, if you're going to do earned income credit. I have seen clients get incredibly appreciative of the value we can bring to them by filing returns and getting a substantial amount of money back. This is one of the most powerful opportunities we have within the United Way and the VITA program to bring money back into the community. So this is helping people who earn income credit who need some assistance. Yes?
Did you speak previously about the 2025 change in Pennsylvania regarding EIC?
Not yet. So it's a good point. We had a recent change here in PA law that the PA has now adopted their own version of earned income credit. It's a piggyback provision. So we're going to have to take a look mechanically how that's going to work within the VITA context. In my view, it's going to be very similar to what happened with the child independent care credit that was automatically calculating off the federal and added on to PA. From my understanding of the new rule, it's going to be a similar situation. They're going to basically tack it on. If you're eligible for EIC for federal, you get a portion of that for PA as well. So I think we're going to take a look at how that's going to work mechanically with the returns. We'll have to figure out if the Department of Revenue is going to get that updated and how quickly for the filing season. Yes?
Back to the Social Security cards, the ones that say if one of the dependents or somebody has the one that says not valid for employment.
Yes.
What do we have to do with the software in that? Because the software doesn't automatically know that. So are there some situations where we have to be aware and manually change something?
Right. If you have a unique situation, the question is about what happens with the Social Security cards that may say not valid for employment or may have some other issues. Those may take a little bit more time to make sure we have everything entered correctly. The other issue we sometimes take a look at for earned income credit is there are some limitations. Again, you have to be a U.S. citizen or resident for the entire year, and your children all have to have Social Security numbers. So sometimes with the immigrant or refugee status, we may not have those qualifying anyway. So we may have some limitations on individuals who are here and they're kind of working on residency or citizenship and they're not quite there yet.
But the software is not going to automatically.
So the software for those, unfortunately, we may need to just double check it's doing the right thing. I think there are a couple manual adjustments we need to make to get that to work effectively. Yeah, I know there's a couple wrinkles with that. Yeah, John.
The alternative to the hug scenario is the stare scenario.
Okay.
Where they said, where you tell them, hey, you get the $3,000 refund. And they go, well, I got $5,000. You must have made a mistake. Yeah.
Okay. Yeah, I'm trying to focus on the positive, John, but yes, I mean, we could have that. Is that all I'm getting? Oh, I'm sorry. I just spent the last 45 minutes of my day helping make sure you get $3,000 back. But yeah, hopefully we don't have many stare downs to say, can I get the guy I had last year then? That they seem to work a little bit better.
The funny thing is, frequently I made a mistake and I go back and I find it.
Oh, okay. Yeah. Well, as long as you're finding your own mistake, that's all right. So yeah, hopefully we have positive results. Again, as we kind of mentioned a little bit earlier, we may see some changes in how things are applying this year. In the years past, we've seen some problems with withholding, that individuals may not have enough withheld off their pay. That has been a problem over the past probably 2 or 3 years where refunds have gone down or maybe they end up owing a little bit of money. So blame it on John if that's the case, if that was their preparer in the prior year. but again, something we need to take a look at. The earned income credit is going to have a little bit more applicability again, so hopefully we can get some refunds back to where their expectations are. We can't do much if they're hoping to get a lot more than what we can do for them. Yeah. Yes, sir.
So if you have a young couple that's under the age of 25 and are making, within that category, they don't get anything?
Correct, unless they have children.
Yeah. If they have children, then, that doesn't count.
Oh, so once they have children, then we're back. We're okay then. So once we have children, now we're back into that. The age test only applies if you do not have children. So once you have children, then we're okay. So it's really trying to. The law is intended to help individuals that they believe are kind of in that stage where they may not. The problem that we had if we had this, I'll go back to the single one here. So if we had, say, a college student who's 23 years of age, they have a part-time job, they're making $10,000 a year, they otherwise would be eligible for earned income credit. However, they probably shouldn't be because they're not working full-time, they're actually a college student. So that's why we have those situations where if you have no children, the IRS is going to say we have an age range. You have to be between 25 and 65 to get that to qualify. Similarly, if you have a retiree who's working a part-time job, they would otherwise be eligible for earned income credit even though they may not need that additional, they weren't the intended beneficiary of the earned income credit. Once you have children, that becomes a different story. That's really where the crux of this has become, to make sure that they can have higher refunds for children to benefit those. So it's basically lower income working individuals with dependent children was the intended market for the earned income credit, if that helps make sense. Okay, perfect. Okay. Okay, yes.
Is there a workaround, because a lot of grandparents have their grandkids, they're responsible for their grandkids, and grandparents can be older than 65. Do they just lose out?
So it's a good question about that scenario if a grandparent's taking care of a child. And so typically, we again, it's going to be based on your earned income. So you have to have earned income in order to be able to take the credit anyway. So have you run into scenarios where we have individuals over 65 working with dependent grandchildren?
Me directly?
Yeah. Oh, yeah. I'm just in general. Yeah. Or okay. So there's some areas we take a look at to, again, the EIC is one in which we have to make sure we meet all the qualifications. So it may just take a little bit more time to go through that process to make sure we identify the correct response. If we do it incorrectly, the IRS can prohibit that individual from taking earned income credit. So we want to be sure we get the answers correct.
I was just wondering. I haven't ran into it, but.
Yeah. Yep. No, absolutely. So definitely. So we want to try and make sure we understand what the rules are, and if there are some unique activities, we want to apply that as best we can. Yeah. Okay. Yes, ma'am.
You have referenced that it said that they're not eligible for work, but do we have to see the Social Security card?
So the question is the Social Security card that indicates not eligible for work. Yes, so typically during the intake process, they're going to provide their photo identification and their Social Security cards for themselves and anyone on the return. That's kind of our typical process here with Invita.
We relied on their W-2s and stuff like that and let them confirm it.
Right, so what they'll do, they'll bring all the information. We'll rely on what they're presenting to us. And if it ever gets to a question where we don't fully understand what they're trying to get to, or if they're trying to direct us some way, we can always have someone else come in and help take a look at the situation. Or if we feel it's just not appropriate, we can have that discussion to see if they belong somewhere else for someone to go ahead and pay them or charge them money to do the return the way they want it done.
I had an experience with EIC where I did the family's return. They had 4 children, and they claimed all 4. Mm-hmm. But when they went out the door, as they were going out the door, I don't know whether she was holding the door, she says, "I'm so disappointed." She says, "We, 4 children, each year we get over $10,000 back.
Oh,
They said, because I claim 2 children where we live, and he claims 2 children,
oh, okay.
at his mother's.
Oh, okay.
And they were cheating around.
Yeah.
And my boss heard it too. And I don't know whether she talked to the main office or what to do about the,
Yeah,
because
so-
they were actually cheating.
Yes.
I mean, the kids were up to 10 years old.
Okay.
They've been doing that for the whole time. They hadn't got married until then.
Oh, okay. Great. So an example we're hearing of a situation, and hopefully not through Vita, right? That was another location?
Lock.
Okay. Oh, okay, good. Yes, we're fine. Unfortunately, I don't want to be too disparaging, but yes, we hear a lot of horror stories coming from
I
there.
don't know what happened to it after,
Yeah.
because she was going out the door, as she told me.
Yeah. So fortunately at Vita, we don't really run into many of those situations because, again, we're basically following the IRS rules. So we have a little different approach. But yes, so there are some people who may try and take advantage of the system by doing head of household or splitting children for earned income credit purposes, that type of thing. We fortunately don't run into that very often here within Vita. So good news is hopefully we don't have those situations where someone says, well, let's go back in again and see if I can change this up by now changing our filing status or number of dependents.
No, she wasn't doing that. He was already out.
Oh, okay. All right. So he was already out. Okay. Yeah.
I don't expect this problem at Gordon Spot.
No, I think Garden Spot, you're going to be okay. I think our Garden Spot volunteer is going to test for that, that we should not be having many issues. And hopefully we don't need a sign to say, please don't discuss your fraudulent activities within earshot of the Vita personnel. We're generally pretty good about that and following our checklists and everything else. But yeah, so a lot of times we're going to rely on the information provided by the client. As long as we believe that they're acting honestly and truthful, we can accept that in faithful representation. Okay. So I did promise I'd talk about the Medicare waiver payments. So this is a program that we're seeing a little bit more of in PA. It's an opportunity where individuals can actually be paid under Pennsylvania law by taking care of individuals, providing non-medical care to individuals in their home. So things we've seen in the past, a couple of clients of mine have done this by taking care of other family members who need care, and they're getting paid under a Medicare waiver payment. Now, typically, these are going to be non-taxable payments for federal purposes. However, they may be showing up on the Form W-2. Now, the good news is the Form 4012 has a pretty good amount of detail on how to handle Medicare waiver payments. That includes being on the D14 of your 4012. There's also a very good IRS tax notice. So if you Google IRS Notice 2014-7, there'll be more information about Medicaid waiver payments as a whole. So these may be reported on the W-2 as line 1 taxable income, but you have the opportunity for any qualified Medicaid waiver payments to make them excludable. That would be by putting them on box 13. So if you know that someone's Medicaid waiver payment eligible, you can actually exclude that on box 13. But you can actually treat those earnings to be eligible for earned income credit. So you would just need to check the box above the amount entered for the Medicaid waiver to make them eligible for earned income credit. Yes?
So should the W-2 actually have an amount in box 13?
So the W-2 may not necessarily. I've seen situations where they do not fully show the excludable amount on box 13. If they have it there, obviously we want to put it in. If we talk to the client and they should be Medicaid waiver eligible, then we can put that in on box 13 on the input to basically make that tax exempt for federal.
So we're taking the client's word that it's actually Medicaid waiver excluded.
Correct. Right. So generally where I see these, the majority I've had with my clients, they've been doing this for a number of years, and it may be a change in how the W-2 is presented, but nothing changed in their position. So I'll take that and say, okay, well, I'm going to go ahead and apply it as if we're still under the Medicaid waiver position. So it all depends on how the W-2 is presented. I have seen it where it shows up as Box 1 taxable, and it should not be. So it should be excludable for federal purposes. Yes, sir.
Who generates the W-2?
Probably the lowest cost provider that the state can find. So that's unfortunately where we're running into most of our issues, is trying to find someone who can do it. I've had more issues than I can mention with government pay, military pay, and with state pay, because their HR systems may try and generate something to get it out on time, but may not be entirely correct. But generally, most people in the Medicaid waiver payment can detail exactly what they're doing. They know that they're getting paid to take care of someone in a non-medical position, which is the entire benefit we have of the Medicaid waiver process.
Who would be listed as the employer?
I'd have to remember how that W-2 is presented.
Is it the state?
I'm trying to recall if it's the state itself or if it's a state agency that shows up as the employer. Does anyone recall? Has anyone seen those? Yes.
I had one last year in my own practice where it was from an employer, not a state agency.
Okay.
But they were very clearly stating that this was to care for the parents in their home.
Okay.
So it was not a state agency, but I couldn't figure out who the company was.
Okay. So there may be a couple of different areas that are getting administering the program on behalf of the state. So it could be a nonprofit or another entity doing those. So it could come from a variety of sources. I'm trying to recall off the top of my head, which doesn't work as well the older I get, is exactly what they look like. But they could be coming from various entities. So it wouldn't just necessarily be the Commonwealth of Pennsylvania paying them. It could be coming from another agency that's going to handle those. Okay. Any other questions on the Medicaid waivers? All right, I want to talk a little bit more about a couple things. Some of these we may not see in VITA, but I just want to make you aware of those. Itemized deductions. So I want to take a look at a couple itemized deductions. Most of our taxpayers will probably take the standard deduction, particularly for the fact that that's actually increased over the prior year and actually increased over what your initial printed copy of the 4012 says. So that one's actually out of date. So the amounts that I showed in week 1 are going to be the current updated ones. But itemized deductions can be applicable if we have individuals that qualify. The most common types of itemized deductions revolve around people who have home ownership. So we'll talk about home mortgage interest, real estate taxes, people who have large medical expenses, or people who are very charitably minded. Now, again, we're going to have a couple issues here because the standard deduction is relatively high. It's over $30,000 for married filing jointly couples. So that means we have to have at least that same amount plus another dollar to get us to take an itemized deduction. Again, the common ones, medical expenses, I'll mention that in the next slide over, but your medical expenses have to exceed 7.5% of your AGI, which is a lot more difficult in today's day and age with a lot of insurances or other backup plans for out-of-pocket costs. The majority of ones I'm seeing are probably people who are entering skilled care facilities. So skilled care facilities may count as medical costs. So you might have some seniors, depending on where you're at, who may be eligible for itemized deduction because they're paying their monthly fee is going to be predominantly medical oriented. So that can get them into an itemized deduction. Otherwise, home ownership is a big one. So getting a Form 1098, which is going to show mortgage interest. We hopefully should not have many issues here, but home mortgage interest is available for the purchase, building, or substantially improving your residence. So qualified residence can be your personal home, a second home. It can be any facility that has basically sleeping, eating, and bathroom facilities. So that can be an RV, it can be a boat. However, I don't want to go too far down the train and think that clients coming into VITA will have 7 homes they're trying to deduct on their Schedule A. That's probably not going to happen. But home mortgage interest, as long as the home is less than $750,000, again, hopefully should not be too much of an issue within VITA. We can take that mortgage interest in full. If they paid points to obtain a mortgage, if they paid points to get an initial mortgage, that's going to be deductible in full the year in which they paid the points. If they paid points to refinance a mortgage, it's more complex. We actually have to amortize that over the life of the loan. So we don't get as much benefit. Now, we also have real estate taxes, again, following the same home ownership, as well as state and local income tax. State and local income tax predominantly is coming off either the prior year return or our W-2 input. Now, the good news is, maybe not for the people in VITA, but maybe for your own edification, we used to have a SALT cap of $10,000 for itemized deductions, which really limited a lot of individuals, particularly ones that were in higher tax-paying states. A couple of my clients are thrilled that the SALT cap is gone for this year, or at least it went up to $40,000. So it's a pretty big increase over the next couple of years. Other ones will be gifts to charity. Gifts to charity are ones in which we can go ahead and calculate those. But typically, I always suggest we always want to make sure we interview the client well before we get too far into the itemized deductions. Whether it's charitable contribution, whether it's medical expenses. You don't want someone coming in with a giant bag of CVS copay receipts and saying, can you add these up? I could, but I'm not. If you want to add those up, you're more than welcome. We'll give you a quiet little spot in the corner, and you can add all those up. And when you come back and you say, I have $313 of copays for last year, I'll thank you for doing all the work and say, we don't need it. It's not going to help you. You're not going to get to standard deduction, or you're not going to get above standard deduction with that amount. But we also want to remind taxpayers that they need to substantiate their expenses. So for charitable contributions, they should have contemporaneous acknowledgement from the charity, meaning that they're getting acknowledgement back from the charity that they made a qualified charitable contribution. Canceled checks don't always work. There's a famous IRS court case where a physician had wanted to benefit his local church and said, well, we're getting a lot of cash collections every Sunday, but the bank doesn't open until Monday. Your safe's not adequate. So let me go ahead and I'll just take all the cash out of the collection jar and give you a check. And then I'll just take the cash to my office, dental office. We have a nice safe to put it in. And then I'll just take it to the bank the next day. The church was happy for that. But what the dentist did is at the end of the year, they said, oh, here's all my canceled checks that the church had cashed. That's my charitable contribution for the year. Not realizing that the IRS quickly found out that why are they all different amounts? And here he was trying to claim the fact that his total checks were a charitable contribution. That's why we need contemporaneous acknowledgement from the charity. Now, that means, do we have to have, if you're driving around and you happen to go through the volunteer fire companies that are doing a boot, do you have to say, hey, hold on a second, let me make sure, give me the donation back, I have to videotape myself putting it in, and if on camera you can thank me for doing it? No. The small ones were probably okay, although most likely it won't matter in this year. If you're going to go ahead and go to a grocery store and they ask you want to round up, that unfortunately is not a charitable contribution. It's not going directly to a charity. They have to be directly to a charity in order for these to qualify. So probably not for 2025. For 2026, whole different story. For 2026, we're going to bring back a de minimis amount of charitable deduction. So that's going to be allowed in addition to your standard deduction. So for 2026, those small contributions can come back. Most times here in 2025 will not hit the itemized deduction. So just want to give you a couple quick pointers on that. For the medical expenses, we can take medical costs for the taxpayer, the spouse, dependents, and individuals who could have been a dependent, but they missed one of the rules, like the gross income test. They have too much income. Maybe they file a joint return, or maybe they're a dependent of another. So that could be a situation where maybe you have a parent who can't claim the child because the ex is claiming the child. You can still take medical expenses for that individual. So they could have been your dependent, except they're claimed by someone else. Medical costs, typically your doctor, your dentist, your eyeglasses, dental, orthodontic, your long-term care premiums can count any prescription medication. I do want to mention legally prescribed medication. Just because someone's taking something that might not be enforceable doesn't make it a legal medication. So hopefully no one's coming in and saying, I have anxiety and I'm self-diagnosed and I'm finding my own medication. That's not legally allowed for medication. It has to be legally prescribed by a U.S. doctor. You can take medical mileage driven. However, we're going to see that in most cases, we're probably not going to hit itemized deduction. In your 4012, they have a very nice list of what is deductible and what's not deductible for medical expenses. So you have extra time or you have extra copies of the 4012 floating around that are old, feel free to read through that and find out what you can and can't take. Any questions on itemized deductions? Yes.
Medicare Part B and D, they're deductible, right?
Yes, so those would be deductible qualified costs. So typically if you enter those in, I believe for the input, you can put those in with the 1099 SA. Those should carry over to be eligible. Now again, those have to exceed 7.5% of your AGI. So if you have a fairly healthy AGI, we're probably not going to get above that threshold. But yeah, we can still try it. Absolutely. Okay. Just want to point out one other thing that we've dealt with in the past is this Affordable Care Act. Only applies for people who have bought their insurance through the marketplace. Typically the healthcare.gov, or more importantly now through Penny. One of the areas we'll most likely see is either they bring in their Form 1095A and tell us they went through the marketplace, or we ask them and they say, no, I didn't get it from the marketplace. We file the return and all of a sudden you get a recheck notice from the IRS saying we need their 1095A. And then all of a sudden they remember and now they had insurance through the marketplace. It surprises me how many people forget where they're getting their health insurance from. But if they're getting health insurance from the marketplace, they should be getting the Form 1095A. It should be available by January 31. If they don't have it, they can log into their account. I cannot tell you how many clients of mine say, I never got one. Okay, go and log into your account. Please get me one, because I can't file the return without it. So one of the things we're going to take a look at for affordable care is taking a look at how we want to report the coverage. So there'll be a question on the return. Basically, everyone has to answer, did anyone have insurance through the marketplace or their state government? If we answer yes, we'll have to go ahead and complete the Form 1095A, which rolls over to the Form 8962. Now, the reason why we do this, and one of the reasons we have to file the returns, is for the premium tax credit. The main reason why people are getting insurance through the marketplace, particularly in VITA, is because they qualify for an offset to their monthly insurance premium. So this is our big discussion that we've seen in Congress as of late, is how much is that premium credit going to be? So the premium credit is going to ask an individual to estimate their amount of income for the next year. I don't know what they do when they ask the question, but we have a lot of clients that feel it's better to say their income is going to be very low, so they have less insurance they have to pay per month. So if they say my income is going to be low, they get a relatively nice sized credit each month, which decreases our amount of insurance, which sounds amazing until we get to the end of the year and the amount that they estimate is nowhere close to the amount of income they actually have, which means, as we mentioned before, we may have a repayment of the advanced premium credit. So the big thing is always informing a client, if there's a change in income, update the marketplace right away. I know it doesn't sound like a lot, but you're getting credits each and every month. So if you get $250 more per month than what you're supposed to get, at the end of the year, that's $3,000 you need to repay. I'd much rather pay $250 each month than to have to come up with $3,000 at the end of the year. So what we want to try and take a look at is how we can help manage that situation. For the most part, again, we are generally close, but every once in a while we have people that go and say, you know what, I'd love to go to the casino this week and hit money. I think we had a situation a couple of years ago in VITA where someone went on an international cruise and they came back and said, oh, I had a great cruise. We had a great opportunity. I won the jackpot. It's like, maybe you should have stayed in a non-extradition country, just gotten off the boat and stayed there, because once you come back to the U.S., you now owe a lot of tax. So we have to try and figure out that. That is an opportunity for the IRA deduction, or a couple other things we might be able to do to get your income beneath that threshold. Again, it's probably going to be a situation where they're going to owe money. So we may have some opportunity to take a look at the return, see if there are some things we can do, or give them some options. So the big thing is that advanced premium credit. Again, for the most part, if they have coverage throughout the entire year, the Form 1095A is relatively easy to enter. If it's the exact same amount for every period of time, I believe we can just enter the totals at the bottom and be fine. If not, we have to go back and enter each month. It's going to give the total amount of insurance, the total amount of advanced premium credit, and how much the second lowest cost plan would be to do the calculation. We don't need to calculate anything. The problem we run into is when an individual hits higher than 400% of the federal poverty line. That is right near the upper edge that we have for VITA qualification. So fortunately, we don't see this as much in VITA as I do in my practice, But if you're over 400% of the federal poverty, there is no cap on your repayment. So if you're over by just a couple dollars, you will have to repay all of your excess amount. If you're under 400%, that is limited. So again, there might be some techniques we can have to have some additional deduction, like an IRA, maybe an HSA, to get your income a little bit lower. So just want to mention a couple of those things there. So, all right. Any questions on the Affordable Care Act? Any issues we're running into that we haven't been addressing throughout? Okay, we're ready for the final elements. The new deductions for 2025. What we've been hearing about for some time, why your 4012s are no longer valid. These were changes all adopted once the bill was signed into law on July 4th. Biggest changes we have to all taxpayers will be the change to standard deduction. That actually bumped up to $15,750 for singles and married filing separately, $31,500 for our married filing jointly and qualifying surviving spouse, and $23,625 for head of household. That is not including the additional amount for age or blindness. Now, a couple of these are going to have a pretty broad impact, I believe, in our VITA program. Biggest one for individuals working with seniors. You may have heard both candidates mention a no tax on Social Security. That was never going to happen. What we have instead is a additional senior deduction. So the seniors, if you're 65 or older as of the end of the year, can get up to $6,000 per individual. The good news is that the AGI thresholds, when we talk about AGI, we mean adjusted gross income. Our limitation under VITA means that we will not run into any limitations. In order to qualify for VITA, you will get the full $6,000. If you're 65 or above, you get $6,000. If your spouse is 65 or above, you get $6,000. I feel like I'm Oprah Winfrey up here. You get $6,000, you get $6,000. Everyone 65 and above, taxpayer and spouse, can get $6,000. That's above your standard deduction. Not refundable, but it's going to go ahead and reduce another $12,000 of taxable income. So maybe that's a situation that could help out, depending if someone might be in the marketplace or if some reason they're not in being able to qualify for Medicare for some reason. We may have additional deduction. It's a great planning technique for those of you who might be looking at some planning between now and the end of the year. It could be a good opportunity if you have some additional deduction this year to maybe consider a conversion of your accounts to a Roth account or create additional income because you have another amount to offset that. So just throwing out as a planning technique for anyone here. Yes, sir.
Do they need to be collecting Social Security for that account?
They do not. No, it has nothing to do with Social Security. So it started as a premise of no tax on Social Security and became well, if you're 65 or older, you can go ahead and collect. So the issue that we run into, the individuals were like, oh, I'm 62, I can collect early. I don't have to pay tax on Social Security. Well, surprise, you do. It has nothing to do with Social Security collection. It is purely based on 65 and older, and as of the end of the year. Yes?
That's probably because most of Congress is over 65 and not collecting Social Security.
Well, yes, a good amount of Congress will qualify for this, although based on some of their outside income, their AGI might be too high to qualify. So they may not have thought about that. Well, either way. Within VITA, we will not have an AGI limitation. It is a little bit lower. So it's AGI is going to be $75,000 for singles, $150,000 for married filing jointly. Yes.
With that additional $6,000 for seniors, how does that affect? Now I'm going to the state. How does that affect the rent rebate program that is involved there?
It will not have an impact on the rent rebate. So this is going to be a federal program only. Now, part of the issue we may run into, you may have seniors that if their only source of income is Social Security, they may not really have a tax liability anyway. So if their tax liability was zero before this, it's going to stay zero. They get no additional benefit from the $6,000. But this could help individuals who have outside income, whether it be earned income or maybe interest or dividend income. They can help offset that from a federal perspective. So within VITA, I don't know that this is going to be the most powerful one we're going to see, but it could help those individuals that have been seniors that might be paying because they have, it's going to offset income from retirement distributions. like IRA, 401k, that type of thing. So they might be able to bring that down a little bit more. So we may see some seniors with more refunds, but it may not affect everybody. Another one, oh, yes, I'm sorry.
Your line or phase out for singles with MAGI over 75.
Yeah.
What does that mean?
So you normally get $6,000, but if your modified adjusted gross income is above 75, we have some limitations. So I just want to put this in here to show that for VITA, we won't have this calculated within the VITA program, but for other individuals, if your income is above $75,000, it's going to reduce the amount that you get for $6,000. It phases out, and all these are relatively newer phase outs, but you can't make $1 million and get your $6,000. It phases out based on your income. Yes?
Are we going to have to enter that, or is TaxSlayer just going to look at the age and say, okay?
TaxSlayer should automatically handle this. I believe most softwares will automatically apply the new senior deduction. So out of all of these, this is going to be the automatic. The first two I'm talking about here, the additional standard deduction or the higher standard deduction, and the additional senior deduction should be automatic. So it's going to be based just on age. So age at the end of the year should be automatic. The next ones will require an input. The next one's going to be that car loan interest deduction. So this is going to be up to $10,000 of interest paid on car loans. It has to be a new vehicle. Has to be a personal use, not a business vehicle, and has to have final assembly in the U.S. Again, phase out for AGI will not apply for VITA, but we're going to take a look and see how that's going to be reported, how they figure out the amount of interest on a new vehicle loan. I have had people that said, you know what, I'm going to go out and buy a brand new car because the government's going to pay for it. I don't know what you read on the internet, but that's not entirely true. They will help you offset the interest only. Yes?
Is that for the year or for the total?
No, that's a year. Yep. So hopefully no one's paying more than $10,000 interest on a car loan. But yes, I guess if you want a brand new Escalade, it could potentially be that high. Yes?
How do they know where the car was assembled? They said I bought a new Honda.
Well, so theoretically, there should be a certification from the dealer as to whether or not the final assembly was here in the U.S. So much like with the electric car vehicle credits, there should be a listing of vehicles that are eligible or not. If someone said, hey, I just bought, for me, a brand new car is a 72 Datsun. Can I go ahead and take it? Well, first of all, if you have to borrow money to buy a 72 Datsun, you're definitely in the right spot here. Hopefully we can get you an earned income credit. But no, that's not going to be one made in the U.S. and not eligible as a new vehicle. Yeah. Yes, sir.
One more question on the senior deduction.
Yeah.
That's separate from the standard deduction?
Correct. Yeah.
So they would still count if they had great items?
Yes. So you can actually do this with an itemized or with a standard deduction. So it's going to be on top of either one. So you can stack these. So the good part is, theoretically, and again, I don't have the age indication on here, but you can actually have over $43,500 of a deduction if you're 65 and older as a married couple. And it's going to go a little bit higher because of the additional 65 and older characteristic. But they're stackable. So they're going to go on top of whatever you're having, whether it's itemized or standard deduction. So we're going to see that for the next couple years, but that's going to be our new deduction. Okay, yes?
Do we know how to report the car loan interest yet?
We don't know exactly how that's going to be. I'm assuming that it's a little bit different from home mortgage interest, and for student loan interest we get 1098s. The government did not require a 1098 for car loan interest at this point. And we're going to see that with the next two deductions I'm going to talk about. They don't have any substantial changes to 2025 in terms of reporting. So we may have to take the client's word, or maybe they can bring in their bill to say, here's how much I have for interest. I imagine because they probably sold a lot of cars based on this position, that hopefully the bank or the lending institution is going to go ahead and give them a detail to say, here's how much you have for the year. It could be off the bank statement to say, here's how much interest you have on the car.
Will there be do you think there will be a separate entry point in TaxSlayer to enter this?
Absolutely. So there will be one. I'm not quite sure if it's there yet or not, but it should be there by the time we go live. With all hope. Yeah. So it may not be the first returns we get out in the year, but it should be there at some point. Okay. All right. I was going to see how if we get any less confusing, but I don't know we're going to get to less confusing with these last two. I want to just mention the qualified tip income. So again, another big campaign was no tax on tips. Sort of. What we're going to take a look at here is actually a deduction as well. So we're going to take a look at the deductibility of tips. Up to $25,000 per eligible worker. That's a pretty significant amount of a deduction. The tips have to be reported to the employer. It can't be like, oh, well, I have tips that I never claimed in cash and I'd like a deduction from my non-reported income. Yeah, hopefully that question does not arise. These have to be reported tips. So it's really an encouraging aspect, really, that hopefully people are reporting their tips to their employer. The other benefit they have is this now builds a income history for them. I have seen people who are in tip-heavy environments who choose not to try to report all their cash tips, which is great till then you try and get a mortgage or a car loan. They're like, well, you're making $12,000 a year as a bartender. Well, no, I'm really making $80,000. Really? Okay. The government doesn't know it. You have to report the tips to your employer. So the tips are going to have to be, as I mentioned, reported to the employer to qualify. They have to be in an occupation that customarily and regularly receive tips prior to the current year. What do we mean by that? The food service industry, hospitality, so front desk staff, people who are caterers, personal appearance, so your hairdressers, masseuses, those types of individuals, transportation workers. I don't know you tip your Amtrak conductor, but your Lyft driver or others, limo drivers, can be considered tipped activities. Now, they don't mention about like officials for football games, if you want to tip them for a job well done. I don't think they qualify in that official, ordinary and customary nature. They don't mention VITA employees, which technically we're not supposed to take cash tips, but we can take hugs or stares, I guess, depending on how the situation can go, or fresh baked cookies if people have that preference. But it's only in certain industries. You can't all of a sudden have your physician say, we're going to reduce your medical bill, but I have a big tip jar here at the end. So if you really appreciated your service, I'd appreciate a little extra in the jar. So it's only for qualified industries. The phase out, again, is going to be fairly high. For everyone within VITA, they're going to qualify. The phase out for income is $150 for singles, over $300 for married filing jointly. Again, big thing to mention, cannot do this if you're married filing separately. If you're married, you have to file jointly to get this to work. There will be a brand new schedule, Schedule A-1, called additional deductions, that's going to help report the qualified tips. This will be an actual input. So the government has not required employers to provide a specific way to develop tips. Now, it could be that we see on the W-2, for those of you who have worked with people in the hospitality or service industry, you may see qualified Social Security tips. Should be on box 7. That can count. But we're hoping that there's going to be some measure that the employer is going to help the employees understand what their tips are. And I'm going to mention that for this one and also our next section as well. That could be a pay stub. If these are being reported to our employees, hopefully there is a pay stub that'll say gross pay, tip income, something along those lines. If that's the case, we can use that amount. We'll hopefully have more guidance between today and the time that the site's open as to exactly what that'll look like. But we're going to rely on the information coming from the employee and hopefully the employer. There is a brand new tax notice, 25-69, which will have more details for both this one and the overtime pay, which I'll get into here, and then open up for questions that I may or may not be able to help fully answer. For the overtime pay, that was another question we ran into on no tax on overtime. Again, sounded amazing. Not entirely what it ended up being. So we can get up to $12,500 per taxpayer. So if you're married filing jointly, that's up to $25,000, again, as a deduction from income. So what this is going to be, it's only going to be the amount of overtime that exceeds your regular pay. So if you think about how overtime works, if you get paid time and a half, so if you work for $40 an hour and you work overtime, you get $60 an hour. This deduction is going to help eliminate that additional $20 per hour. It's only kind of the half portion of the time and a half that this is going to eliminate. But it's up to $12,500. So it's going to be phased out again. The phase out relatively high, 150,000 for singles, 300 for married filing jointly. Again, you have to file jointly. You cannot file separately to take this. So you have to have a valid Social Security number with a valid and authentic Social Security number. So you have to be engaged in an employable activity. Self-employment doesn't count. You can't say I'm an independent contractor. I worked overtime. I paid myself more money. Well, you didn't really pay yourself more money. It's all self-employment income. This has to be coming from a W-2 position. Overtime has to be required by federal labor law issues, Federal Fair Labor Standards Act. So it cannot be the employer has decided we're going to pay you extra overtime. So there's still some discussion. We'll see what happens ultimately. I know there were some maybe some technical corrections we'll see. There may be some unions and other things that have double time or triple time on holidays. We'll see how that impacts the ultimate law here. But traditionally, we're taking a look at that time and a half perspective. Again, take a look at the notice. Hopefully we'll have more information. The recommendation right now, again, there's no specific W-2 element that's going to say, here's your overtime component. So it may be taking a look at that final pay stub that should hopefully break down all those different components. We don't know exactly what that's going to look like. The government has not mandated a specific form for employers for the 2025 year. So we're all in this kind of together for figuring out how that's going to look. But this could be a great benefit between the tip and the overtime for some of our workers. This is going to be on top of what they can get for the earned income credit. So it should not impact their earned income credit by taking this deduction. So hopefully we'll have more answers, but I will entertain any questions we have now to the best that I can either know that or make something up that sounds logical. Yes?
I just have one question.
Yeah.
Under cannot claim if filing, married filing,
Yes.
have new Schedule 1A to report the qualified.
Oh, sorry. Yes. No, that should be the overtime. Sorry about that.
So that actually has to go on that additional deduction.
Yes. Yeah. So we're going to have a brand new Schedule 1A that's going to show the qualified tips and the qualified overtime. I apologize. I copied part of that over from the prior slide. So that should say qualified overtime. I'm anticipating the best way we're probably going to find this is with the final pay stub of the year. So that might be something the client needs to bring in now in addition to their W-2 to show how much overtime that they've actually earned for that period.
But you have to really look at that to see what hourly rate is listed on their stub for overtime.
Yes, so that's...
Some companies put the straight portion as a line item and then the premium portion as a line item.
Correct, right. So that might be an area we need a little bit more investigation. So we're definitely going to take a look into this and then hopefully come up with better guidance by the time we actually hit the tax season. Again, the employers were kind of, they've had some notice since July 4th this was happening, but they haven't quite figured out exactly how that's going to work. This might be a little bit easier for some of our larger payroll providers, the ones out there that are used to doing these. I'm already getting notifications from some of the payroll providers I work with, like ADP, that are reminding employers of what they need to do to handle tip and overtime. So they're making sure that they have some sort of reporting mechanism. It may be a letter, it may be something else supplementary from the employer that says, here's what you need to report on your return. That would be amazing. That would be great if they could provide that. For those of you who are used to seeing the W-2s that are the handwritten for-print copies, I have no idea what we're going to do with those. We'll have some creativity. Well, not really. We'll follow the law, but we'll figure out how we come up with the overtime amounts off of those.
So that would also apply for a 1099 as well. Like, I'm an Uber driver.
Yes.
And I get tips through the app.
Correct.
But they're not recorded anywhere separately now in their system.
Okay. Yes.
So they're going to have to alter the tax summary that they're giving their
correct.
contractors.
Yeah, so that's what they're hoping is that when you're talking, like with the rideshare drivers, the Ubers, the Lyfts, the DoorDashers, they know in their system how much you're getting based on the breakdown, but they don't necessarily provide it to you on the 1099. So the government, I think, is going to strongly encourage them to figure out how to basically give you a breakdown and say, here's how much you got in tip income for those periods. And typically what we may see, and I'm glad you brought up the rideshare drivers, because you may have people who work for multiple services. So someone may be an Uber driver, someone may also drive for Lyft, someone may also do DoorDash. or some of the other food delivery services. So we may be getting multiple sources of information. Again, those are 1099 individuals. That's okay for the tip side. W-2s can only work for the overtime. So, yes. Yes, question.
If you're working for a small company and you work overtime, but the overtime is just more hours at your base pay,
Okay.
are you out of luck?
Yes. So the question is, if you're working for a small company that's not under the the Fair Labor Standards Act and not paying time and a half, you're probably out of luck, because this is only for that additional component of extra pay. So we'll hopefully get some more guidance on that, but typically it's only going to be for that premium component on the overtime, not the regular pay. Yeah, so hopefully we'll get more activity here. We had a little bit of an issue with the government shutdown you may have heard about that. The government wasn't operating for a little bit of time, so it kind of delayed a little bit of guidance we were hoping to get here in terms of how these would be implemented. Plus Congress was dealing with that issue rather than trying to figure out what corrections they want to make or enhancements they want to make in terms of the application of law. So we're hoping in the next couple of months, because Congress people now have nothing to do between now and next tax season, that they'll get these issues fixed for us and be able to provide some decent opportunities for us to do the right things. Yes?
But Pennsylvania will still tax tips.
Oh, Pennsylvania's going to tax everything they can, yes. So it's going to be taxable for tips for PA. Yep, the main rule change we have is the new, basically the EIC for PA. And there'll be another opportunity we'll talk about once we get more information on that as well, on how that'll implement. But PA is still going to tax it. Yep. Okay. Yes, sir.
As it stands now, if there is more than time and a half, the income above the time and a half is still taxable?
So that's kind of one of those areas where we need to make sure, is it just the half portion or is it any time? So if we're talking about, what they're basically taking a look at, the Fair Labor Standards Act requires time and a half for overtime, but some employers may pay more than time and a half. So there could be, for people that might be in the medical field, if you work a holiday, you might get double time. My son works in the construction industry. They get triple time if they work on a Sunday or a holiday. I never see him on Sunday and holidays, which is probably the right move here for him. But, that's a question. Is it just going to be the is it all the extra component or only a percentage of that? Is it only going to be a portion? So we need to get a little bit more clarification on what that looks like. So, yeah, we'll see how that plays out. Okay. Yes, sir.
For the tip deduction, person who gets a 1099 NEC, that means they're not unemployed. They're they would not qualify.
No. So for the tips, you can still use the 1099 to qualify for the tip income. Just for the overtime is the only one you need the W-2. So as we mentioned, like say Uber drivers are going to get a 1099, not a W-2. They're going to be getting tipped because they're in their transportation industry. If you are potentially a hairdresser who is not an employee but an independent contractor, we typically don't see those here in PA, but theoretically your 1099 may be comprised of tip and regular pay. Servers could be that way. If you maybe use a catering facility or your independent contractor for a wait staff, you might be getting a 1099 NEC, which is comprised of tip and regular pay. So again, we'll have to figure out how much is that going to be considered tip income. Yes?
The key to all this, though, is with tips, if they don't report it to their employer, they're out of luck.
Yeah, so the basic premise with tip income, the tips need to be reported to the employer or the person making the payment. You don't get a deduction for income you don't claim. And technically in VITA, we want you to claim all your income. So you can only be getting a deduction for the tip income reported to the employer. Absolutely. Great. Yes?
Well, is there any advantage? The current way is most waiters and waitresses, they don't tell you what their tip income is. So, and I have very few clients that have said, oh, I had tip income of $1,200. So is there any advantage to them to report this now?
The advantage, so the question is, what happens to the people who haven't reported tips? And there's kind of two different options we have. One is they could voluntarily report it to their employer, who then adds it to the W-2. There's also an additional tip form that you can actually add cash tips to your income tax return if you so choose. Most people so choose not to do so. But the advantage you have, one of the big things I see is for people who want to demonstrate sustainable income, if you want to go get a car loan or a mortgage and your W-2 or your 1040 shows a lot less income than what you have, it's much more difficult to qualify for financing. So the advantage could be in this case is that you report your tip income, you get a deduction for up to $25,000. So that might be an incentive for you to start reporting your tip income. The downside is now you're going to have to pay for it for state and local purposes, which you didn't before.
But it also increases your Social Security benefit 40 years later.
Correct, right. So if you report it through your employer or you're doing the tip income, it's going to be increase in Social Security benefit. That's correct. It's incentive to get people to start complying with the tax law. They've always have been required to report all income from whatever source is derived. Now we're encouraging them to go ahead and report that cash system. We're also seeing a little bit more non-cash transactions, so it's a little bit harder to go ahead and get cash tips. Hopefully no one's going to get tipped in pennies, so we won't have any more of those coming. But if anyone has a collection, hold on to them. They're paying a good amount of money for those now. But we're going to see a lot more cashless transactions, things like maybe cash transfers, Cash App, Venmo, those types of things. If you've ever been to a spot, they may say, rather than have a tip jar, it's Venmo me money or send me money by Apple Pay. Those systems can all record where your money is coming from. That's the next issue that Congress needs to tackle of how we report money transferring between individuals. So if you decide to have a part-time job playing music at a restaurant and you used to have a tip jar and you used to make a bunch of money in cash and you never had to report it, and now what happens is millennials don't know what cash looks like, but they'll gladly pay you out of a phone. So now all of a sudden now you have a Cash App that shows that you're making $200 a night. Well, now, unfortunately, you're probably going to have to report that to the government whether you like it or not, because the Cash App program is going to issue a 1099-K. So the intent is the government wants everyone to report things as they're supposed to, so the tip income, theoretically, whether you get it in cash or anything else, should be reported as taxable income. It should have been there all along, but are we going to convince people to go ahead and change their minds on that? Maybe, maybe not. But again, I think the benefit we have is one, now you have documented income for purposes of if you want loan or credit. Two, building a Social Security base could be a benefit. You can use that also if you wanted to go ahead and contribute to your own retirement plan. So it could allow you some additional earned income to do an IRA, Roth IRA, possibly even a SEP or simple, depending on your plan. So not a huge carrot, but you can report more income and not have to pay tax on it. So that's our benefit. Yes?
Could that be a downside for like the rent rebate if you're now claiming the tips?
Theoretically, it could be a detriment to your rent rebate or tax forgiveness for PA, because then your income is going to go up. Now, technically, you're supposed to report all income anyway. So if you ever take a look at the rent rebate or the PASP, you're supposed to put in non-taxable amounts or gifts or those types of things. So theoretically, if you're not doing that, you're kind of already violating the spirit of the law. We won't get into that discussion today. That's not going to be on the recording. But we do want to kind of make sure we have everything reported appropriately. But you are right. If we are seeing an increase in income that could have some applicability at the state level for purposes of the rent rebate or tax forgiveness, also could increase your local tax as well.
Yeah, if they weren't reporting the tips before and just keeping the cash, they never, when all of the rent rebates that I've done, they never say, oh, by the way, I had $100 tip that I didn't claim.
Right.
I mean, that didn't happen.
Yeah, I don't know we're going to change everyone to go into the position. It's not that they've gotten an added benefit. There's some ancillary benefits to it. Again, but that's only if they care about that. But I don't know if this is going to be we're going to see a groundswell of all of a sudden we brought in all this new money to the economy because everyone's reporting their tips. They should be, but I don't know if that's what's going to happen. All right. Other questions? Okay. Well, I appreciate everyone coming out. It's always been fun to do these. Trying to remember how many years I've been doing this for, but always appreciate people coming out. Great to see returning volunteers with great questions, and hopefully new ones that we haven't scared off here into seeing how the wonderful world of taxation can occur. But it's been my pleasure to go through these past couple weeks and talk to you about dependency, filing status, income, and now the most fun one, deductions and credits. So enjoyable tax season, everyone. Hopefully you have a great time. We'll give you some more information as we get closer to tax season. Thank you very much.